If you look at the misinformation, like last week we were just measuring it and stuff, like 27 million ounces or 50 million ounces of silver has disappeared from the COMEX depositories. Well, it hasn't disappeared. Yeah, it's gone to England, which is where it came from 4 years ago. The arbitrage, the price of silver was higher in New York. Then the arbitrage reversed because London had shipped so much silver out both to New York and also to India. The arb reversed and people were air freighting silver back to London. COMEX depository holdings of silver have fallen 90 million ounces in the last few years. That's not true. First off, there's no big deficit in silver. There is a surplus, which is being more than absorbed by investors. They were so backed up that they stopped buying silver scrap. They're traditional sources of material. I started the business in the 1970s and they had strictures and people would say, well, China, you can't export silver. And then I found out that, yeah, you can. No, you can't, but the Chinese government can. Silver had been lagging gold in the price increase. And that reflected the fact that you had a lot of disenchanted investors selling their silver. So net purchases of silver by investors as a group was lower than gross. You saw rising gross silver investment, but there were people selling into the higher prices, which kept the price down. And you actually got to the point, until August of this year, you got to the point where refineries had so much of this 90%, 99% silver investment products, 1 ounce, 10 ounce, 100 ounce, being sold back to them that they had to melt down, recast as 1,000-ounce bars, and in many cases refine to get it up to good delivery standard, so that a refiner will buy 100-ounce bars or 10-ounce bars, but the refiner sells 1,000-ounce good delivery bars, and it needs to refine it up to good delivery standards and recast it as 1,000-ounce bars. They were so backed up that they stopped buying silver scrap, their traditional sources of material. They were saying to their traditional customers, we can buy this stuff, but we got to pay you a deep discount, and it's going to be months before we have outturn because we're so backed up.
The quiet story here isn't demand exploding. It's frustrated investors unloading silver at exactly the wrong time. What Jeffrey Christian is pointing out is structural pressure, not price weakness. Refineries were so flooded with retail bars that they literally stopped buying scrap, something that only happens when physical flows are distorted. That tells you selling pressure, not lack of interest, capped silver's price. This mirrors prior cycles where retail capitulation delayed upside. When refineries demand discounts and months-long delays, liquidity is strained beneath the surface. For investors, that's a warning that price suppression can be mechanical, not fundamental. And those moments historically precede sharp repricing. Next, Jeffrey Christian explains why that bottleneck suddenly vanished.
That started to disappear at the end of August. And that's when the silver price really took off. So it was partly strong investment demand, but it was also a sharp diminution of investors selling, stale bull investors, disenchanted investors selling. It's the same mechanism that we saw in 1979 and in other periods of time, like 2000 to 2004, where the price of silver had been depressed to some extent because investors were selling. And then one day the investors as a group said, hey, I think if I wait until tomorrow, I'll get a higher price. And tomorrow the price was higher. And they said, I think if I wait till tomorrow, I'll get an even higher price. And that's the same mechanism that we've been seeing really since late August of this year. Investors who were disenchanted, they had bought during the Wall Street silver scam, or some of them had bought in 2011 at the peak, and they've been holding it at a loss. And all of a sudden they say, hey, I can get my money back. And then they say, wait a second, if I wait, I might actually be able to turn a profit on this.
Yeah, you can really see how driven by investors this move is.
This isn't a supply shock. It's a psychology flip, and history shows that matters more for silver. Jeffrey Christian ties this directly to 1979 and the 2000 to 2004 period, when sellers simply stopped feeding the market. Once holders expect higher prices tomorrow, supply dries up overnight. That's not momentum trading. That's inventory withdrawal. Many of these investors bought at the 2011 highs and spent over a decade underwater. When break-even turns into optionality, behavior changes fast. For portfolios, this means silver rallies tend to accelerate non-linearly, driven by refusal to sell rather than aggressive buying. And that dynamic is far more unstable than most headlines admit. The next misconception Jeffrey Christian addresses explains why shortages are being misunderstood.
And that brings me to another point I wanted to bring up with you. I know you do a lot of work to dispel misconceptions in the silver market for investors, and probably especially for people who might be new to the market. So is there anything key that you would highlight there right now that you are seeing?
Well, I think that you're seeing several things. First off, there's no big deficit in silver. There is a surplus, which is being more than absorbed by investors. But in terms of newly refined silver coming into the market, there's plenty. As I said, the smelters and refiners are backed up with it. There's plenty of new supply coming in, and fabrication demand is off. On a global basis, it's probably off about 3%. But if you look at key markets like India, fabrication demand might be off 35, 40% this year, partly because of the higher price. So there isn't a gigantic deficit. There are spot shortages in London due to strong investment demand, and in India due to strong investment demand. While fabrication demand's off, people are buying bullion coins and bullion medallions as much as they can, and they're really complaining because the government's putting in import duties to try to quell the demand for gold and silver in India right now. So, but you got spot tightness. You don't have a big short tightness. You don't have a lot of other issues.
This is where silver narratives routinely go wrong. Tightness gets confused with deficit. Jeffrey Christian is explicit. Global fabrication demand is down roughly 3%. And in India, it's down as much as 35 to 40%, which directly contradicts the runaway shortage headlines. What's happening instead is localized stress caused by investor hoarding, not industrial collapse. That distinction matters because true deficits drive sustained pricing power, while spot tightness creates volatility. Import duties in India are distorting flows, not eliminating supply. For investors, this means silver strength isn't built on consumption growth. It's built on capital behavior. That's more fragile, but also more explosive when sentiment shifts. And that leads directly into how misinformation spreads through location data.
It's interesting because, China a couple of weeks ago announced that it was putting in increased strictures on silver exports. And the reality is they've always had strictures on silver exports. I started the business in 1970s, and they had strictures. And people would say, well, China, you can't export silver. And then I found out that, yeah, you can. No, you can't, but the Chinese government can. And the Chinese government was selling excess silver month after month in the 70s, 80s, and onward. The idea that, all of a sudden China's saying you can't export silver or there are export restrictions and limits, they've always been there.
Yeah. The China news, that was one point that I was hoping you'd mention. So glad we went into that one. And then, okay, so for silver, no deficit, but I wanted to ask a little bit more about the location of silver, because we do seem to have had market dislocations this year due to silver being there, but not necessarily in the right location. So is
Right.
that a theme you see continuing next year?
Yeah, I think it is, but it's amazing because if you look at the misinformation, like last week we were just measuring it and stuff like, 27 million ounces or 50 million ounces of silver has disappeared from the COMEX depositories.
This is a textbook example of how recycled headlines manufacture panic. China's export controls aren't new, Jeffrey Christian has watched them since the 1970s, yet every cycle they're framed as a sudden supply shock. The real issue isn't disappearance, it's relocation. Silver moving between COMEX, London and India gets spun as vanishing metal. That's not a shortage. That's logistics and arbitrage responding to price differentials. When investors mistake movement for depletion, they overestimate risk and misprice opportunity. For serious market watchers, this is a reminder. Follow inventories across systems, not social media claims. What Jeffrey Christian explains next exposes just how misleading COMEX drawdown headlines really are.
Well, it hasn't disappeared. Yeah, it's gone to England, which is where it came from 4 years ago. And you can see the LBMA data and you can see the COMEX data. And there was a big surge there was a big decline in silver in London. And there was a commensurate rise in the New York market because the arbitrage, the price of silver was higher in New York. Then the arbitrage reversed because London had shipped so much silver out both to New York and also to India. The arb reversed and people were air freighting silver back to London. So you saw about 50, 60, it went from 530 million ounces down to about 450 million ounces. You saw a lot of silver come out of COMEX registered depositories and go back to England or off to other places where it wasn't there. There was also a trend on the part of investors saying, I want my physical silver, and I don't necessarily want it in a COMEX registered depository. I'd rather have it in a non-registered depository where it doesn't show up in statistics. So you were seeing some of that going on too, But then there was somebody, I saw something online and it was like, oh, COMEX depository holdings of silver have fallen 90 million ounces in the last few years. That's not true.
This is where panic headlines quietly fall apart under basic data scrutiny. As Jeffrey Christian points out, silver didn't vanish. It moved, driven by arbitrage between New York, London and India. A shift from 530 million to 450 million ounces sounds dramatic until you track both COMEX and LBMA simultaneously. Investors pulling metal into non-registered vaults doesn't signal shortage. It signals distrust of visibility. For markets, that means fear narratives inflate faster than fundamentals. Next, Jeffrey Christian explains why even these drawdowns are being wildly exaggerated.
The 530 million ounces was like 4 months ago, 3 months ago, and that was a record. And at 460 million ounces, we're still, 3-4 times higher than we were for most of the last 40 years. So there's plenty of COMEX silver still in the COMEX system. But you have these promoters just saying anything, and quite frankly, the people who are involved in the core silver market are making money hand over fist, and they don't mind if part of the reason why they're making money hand over fist is because a lot of investors are believing inaccurate information and buying silver and gold.
Yeah, it gets very tricky when it comes to these silver market nuances. So thank you for going into that.
You should be long these metals from a long-term investment perspective, but you have to have a realistic view of how high they can go and how high they can stay. Because, there's one thing to pick a spike, and then there's another thing to say, what's the long-term sustainable price? Everyone knows that silver rose to $50 in 1980. They don't know that the annual average price was like $21 that year.
This is a reality check most silver investors never hear. COMEX inventories today are still 3 to 4 times higher than historical norms, despite claims of collapse. Jeffrey Christian exposes how promoters profit when investors confuse spikes with sustainability. Silver touching $50 in 1980 sounds explosive, until you realize the annual average was just $21. That distinction matters for miners, margins, and long-term returns. Chasing peaks without understanding averages is how portfolios get wrecked. What Jeffrey Christian sees next explains why averages matter even more than headlines.
And everyone knows it rose to $50 in 2011, but they don't know that the annual average price was like $35 a year. So you look at the gold price or the silver price today, you look at the gold prices, wow, it's at a record $4,400. That's right. And through November, the average was 3,800. So, we'll have an average price that probably will be over, well, I'm not sure where it'll be. It'll be higher than 3,800 for sure. But people will say, what are you talking about? Still, gold was only $4,000. It's 4,500 right now. It's like, well, yeah, but you're talking about a daily price versus an annual average. And the annual average is important for mining companies and smelters and refiners and industrial users and jewelers and, and others.
This is where investors confuse excitement with economics. Daily prices grab headlines, but annual averages determine real-world decisions: wages, capex, and production. In 2011, gold felt euphoric, yet the average price told a far calmer story. Today's $4,400 print masks a $3,800 average that businesses actually plan around. As Jeffrey Christian traces, averages shape sustainability, not spikes. If you're investing long-term, ignoring this distinction means misjudging risk at precisely the wrong moment, and that feeds into whether gold is truly becoming mainstream.
To what extent do you think gold is becoming more mainstream at this point?
I don't know that it's becoming more mainstream at this point. There has been, really since we've seen in the early 80s, I used the term the democratization of the gold market. And it really started in the 60s in Europe, and then the United States in 75, and then Japan in 79, 80, and then India in the 80s, and China in the 90s. You've seen deregulation of the gold market, and you've seen an upward shift in the investment demand curve. So more investors are more interested in gold. And there's also been a lot of innovations. If you go back to the 1970s, if you go back to 1979, if you wanted to buy stock, you might pay $100 commission to buy 100 shares of IBM. Now a lot of things are commission free, or the commission is $5 or less. So that's changed. But in the gold market, you've had the rise of the ETFs. You've had the rise of bullion coins. 1979, 1980, you had the Krugerrand. It wasn't until the mid-80s that the maple leaf and the eagle came along.
Gold didn't go mainstream, access did. Jeffrey Christian draws a sharp line between cultural acceptance and financial plumbing. ETFs, bullion coins, and deregulation lowered friction, just like commission-free stock trading did decades ago. But ease of access doesn't mean conviction. Gold remains a sideline asset until fear, policy stress, or currency risk forces attention. That gap explains why gold can surge without universal buy-in. Next, Jeffrey Christian explains why that tension may persist far longer than most expect.
And it wasn't until later in the 80s that the purse mint started generating gold coins, and the Philharmonic in Austria came later. So you've got gold coins. You've got gold coins that are more readily available. You have easier ways of going about buying coins and other things. You have ETFs. There's a lot more sophistication in terms of overall investment assets. If you go back to the 1980s, maybe 35 to 45% of the money, financial assets in the United States were managed by professional managers, and the rest were managed by individual investors. Today, I think institutional fund managers probably manage about 80% or more of the money under management. So you have a more sophisticated and ready to diversify group. So there's a lot of things that have made it easier for more people to invest in gold. That said, I think the attitude toward gold remains something of a sideline. So I don't know that the attitude toward gold has been mainstreamed, but there has been an increase in it.
That's an interesting perspective. Do you see that mainstreamization of gold coming, or do you think it stays as it is?
I think, we've written some things recently, and we just produced a report last week, uh, a market commentary that Silvercorp actually paid.
Gold didn't become easier to buy by accident. It became easier because capital itself became institutionalized. What stands out here is the quiet shift from retail-driven markets to institutionally managed capital, now controlling roughly 80% of US financial assets versus under half in the 1980s. ETFs, sovereign mints, and lower transaction costs weren't about democratizing gold. They were about making it allocatable inside professional portfolios. As Jeffrey Christian has noted before, accessibility doesn't equal conviction, and gold still sits on the sidelines of most asset models. The infrastructure is ready, but sentiment hasn't caught up. What comes next depends on whether institutions stop treating gold as optional insurance and start treating it as core allocation.
A sponsorship fee to help us distribute it, called the Gold and Silver Renaissance 25 years on. Because in 2000, we said this is going to happen. There will be an upward shift in the investment demand curve for gold. Then central banks will get into it, and then silver will join. And all of that's happened, and it's been going on for 25 years. And our thesis was in the year 2000 that the economic and political environment going forward would be much more hostile than it had been previously. And as bad as things were in the 70s, we thought that, and in the 60s and 70s and 50s, you'd have 1 or 2 years of political and economic problems. People would buy gold, then things would get better and they'd buy less gold. But we said going forward, starting in 2001, we would see a much more persistent demand for gold, more investors, more types of investors in more parts of the world buying more gold at higher prices for a longer period of time. And where you used to see these 1 or 2 year spikes, we said this is going to go on for decades. And we're 25 years, we're a quarter of a century into that gold and silver renaissance, where investors have rediscovered the value and wisdom of having some of their wealth in gold and silver.
This isn't a gold boom. It's a 25-year structural trend most headlines still frame as a trade. The key claim here is persistence. Demand didn't spike and fade like the 1970s, because the political and monetary stress never resolved. Central banks entering the market after 2000 validated that thesis, with official sector gold purchases now exceeding 1,000 tons annually in recent years. As Jeffrey Christian's long-term models suggest, this wasn't speculation. It was a regime shift. Investors who still wait for a top may be misunderstanding the timeline entirely. The real question is whether portfolios are positioned for a decades-long cycle, not a short-term move.
And we don't think that we're halfway through that period. So we see this continuing for a long period of time.
Okay. So this is a much longer trend toward that we need to keep in mind then. And I want to, go ahead.
There are two sides to the equation. On the one hand, as I said, there are all kinds of mechanisms that make it easier for people to invest in gold. And there are people buying more gold. I mean, we saw 35 million ounces or more of gold bought this year. And we're probably going to see even more next year if we're right on our outlook for the economy. But the other thing is, gold's doing well, silver's doing well, investors are buying it, but the world economy is not doing well. And even while stocks and bond prices have risen sharply, and stock prices have risen sharply on an index basis, even though they're rising, there's a lot of concern, anxiety, and dissatisfaction and worry in that market. So the shift to paying positive attention to gold and silver is partly because gold and silver have positive stories, but it's also partly because other assets don't have positive stories.
Gold demand isn't rising because investors feel confident. It's rising because everything else feels fragile. The data point matters. Over 35 million ounces bought in a single year signals allocation stress, not enthusiasm. Equity indexes may be up, But breadth, real earnings growth, and bond confidence tell a different story, especially heading into tighter liquidity cycles. As Jeffrey Christian often emphasizes, gold benefits when other assets lose narrative credibility, not just when gold looks strong. For long-term investors, this is less about chasing metals and more about acknowledging systemic discomfort.